Welcome to Beavers Wealth Management's August 2025 edition of Let's Talk Markets. Our goal remains clear: to educate, inform, and empower the families and businesses we serve. So if you find today's discussion valuable, always please feel free to share it with those who might benefit. And this month, we're digging into the data, kind of behind the headlines, from tariffs to GDP, and closing out with a few fun market facts that I bet you didn't know. So let's dive into it. All right, we're going to start off by doing something called our tariff tracker, right? We're going to follow the data, not the drama. That's the headline of this point. So here on Let's Talk Markets, we've talked a lot about tariffs over the last few months, right? It's been on everybody's mind. But now we're finally starting to get some hard data that we can look at. And it's giving us a clearer picture of what's actually happening beneath the surface. And that's the theme we're going to discuss today. We're removing the political noise and we're just talking about the numbers. Whether good or bad, we're here to follow the data and examine exactly what reveals about trade policies affecting the economy. And so let's start with the hard data on how much revenue we've actually seen from tariffs this year. And it might surprise you. In June 2025, the U.S. government collected, you ready for this, $26.6 billion in custom duties, the highest monthly total on record. That puts total tariff revenue for the fiscal year 2025, which still has a few months to go, at $108 billion, already surpassing the previous full year high of $99.9 billion set in 2022. So what's driving the surge? Well, since President Trump returned to office, we've seen the implementation of a 10% baseline tariff on nearly all U.S. imports, along with higher duties on specific sectors like steel and aluminum and passenger vehicles, and particularly punitive tariffs on Chinese goods. While some tariffs were temporarily paused during, remember, Liberation Day, trade negotiations, those that remained were significant enough to drive a sharp increase in revenue. So just take a look at the chart. It tracks U.S. tariff revenue going all the way back to the 1950s. And what stands out isn't just the long-term trend, it's the explosive growth over the past few months, highlighted in the jump from March to June 2025. But here's an important caveat. Even with that all-time high in June, tariffs still make up less than 3% of total U.S. federal revenue. The bulk of government income still comes from individual income taxes, corporate taxes, and Social Security contributions. All right, so you're asking yourself, if it's not a major revenue source, what's the point? The administration has made it clear tariffs are a negotiation tool, not a budget funding mechanism. The goal is to reshape trade agreements. And in many cases, if we look at it, the deals being struck kind of show that. Recent agreements with the EU, Japan, the UK, and several Asian nations have lowered U.S. tariffs on select goods in exchange for major investments into U.S. energy and manufacturing and expanded access for American exports. Still, there are arguments against these measures, right? Some economists warn that American consumers, you and I, will bear the brunt of the cost increases. So according to estimates from Wall Street, that's kind of right. 70% of the additional tariff costs will fall on U.S. consumers, 70. 15% will hit U.S. businesses, while the other 15% will impact foreign exporters. So, in other words, even if tariffs boost government revenue and shift trade dynamics, the day-to-day impact may be felt most at the checkout counter. Now, it's also worth highlighting how the new trade deals have unfolded globally. So here's a snapshot of the Trump administration's trade negotiations since April. The United Kingdom maintains a 10% tariff, but eliminated prior tariffs on steel and aluminum, plus a cap on car import duties. All right, what about Vietnam, Indonesia, the Philippines? They accepted higher U.S. tariffs, up to 20%, in exchange for mostly open markets for U.S. products. Japan and the EU, they actually lowered tariffs on their exports to 15%, but with a condition: major investment into U.S. infrastructure and energy, and larger purchases of U.S. goods. And we just recently learned this week the EU will be pausing retaliatory tariffs while the U.S. will still continue to impose their tariffs on their goods sold here. So far, 6 deals have been formalized, with more expected as August's deadlines are approaching. So what's the broader theme? Leverage tariffs for bilateral concessions, even at the cost of short-term trade imbalances. Now, lastly, I thought this chart was kind of cool. Let's look at the global map of all tariffs. And you can see here, there's quite a few nations out there that are in the 26 to 50, right? The darker the color that you see there, the higher the tariffs. And so across the board, you've got a number of places that are anywhere between 25 to 50%. But I thought this was a good picture to give you an idea globally where we stand from a tariff perspective. So what's the bottom line? While trade headlines often feel political, this is one of those areas where the numbers, not just the narratives, are starting to come into view. So whether you support the policy or not, the data is undeniable. Tariffs are materially reshaping U.S. trade, they're increasing costs, and they're influencing global economic relationships. And for investors, this serves as a key reminder. Watch what's actually happening in the data, not just what's being said in the headlines. So, to help put things in perspective, it's time for one of my favorite parts of this is Ryan's Market Fact. And this month's is a reminder of just how rare calm can be in markets like these. And so Ryan titled this one as "Crisis is the Constant," which I thought was a very clever way to look at the way we've been seeing things here in this market, even in this year. If you're waiting for the perfect moment to invest, we all are, right? When headlines are calm and uncertainty is gone, well, you're going to be waiting a long time. This chart tracks the S&P 500's total return since 1989. It shows the growth of just $1 invested, rising to $38 through wars, recessions, terrorist attacks, pandemics, and financial crises. The message? There is always a reason to worry. Yet markets have a long history of rewarding long-term investors who stay the course through all the noise. Uncertainty, we know, it isn't new. It's the norm. But discipline, not timing, is what drives long-term success. All right, I love that one. We're going to go on to our next point, which I titled GDP Rebounds, but the story isn't so simple. Because after a start, and it was a soft one to the year, the U.S. economy appears to have found its footing, finally. According to new data from the Bureau of Economic Analysis, real U.S. GDP rose by 3% in the second quarter of 2025, a sharp reversal from Q1's decline of 0.5%, and a signal that economic momentum may be stabilizing. But beneath the surface, this isn't your average recovery story, right? Earlier in the year, imports into the U.S., they surged ahead of April's tariff announcements, and we've talked about this. A move widely viewed as businesses, they front-loaded inventory in anticipation for their higher cost. And that surge in imports actually pulled Q1 GDP down as imported goods subtract from GDP calculations when not yet sold. And so, by contrast, Q2 reflected the other side of that trade dynamic. With tariffs in place and inventories already built up, import activity slowed while sales of previously stocked goods accelerated, lifting GDP in the process. So both Q1's decline and then Q2's bounce, they're driven less by organic growth and more by strategic adjustments to a changing trade landscape. Now, the full impact of the new tariff regime and whether growth can kind of sustain without inventory distortions, that remains to be seen. Okay, so you're like, Christopher, why do we go through that economic lesson there? Why does it matter for me as the investor? GDP is the broadest measure of economic activity. It influences everything from earnings expectations to interest rate policy, right? And while 3% growth is an encouraging headline, understanding the underlying drivers, it's essential. This kind of volatility reinforces the need to look beyond short-term data and consider long-term positioning. All right, now everybody's second favorite topic, let's take a look at inflation around the world. And how does the United States compare to what we're seeing globally? Inflation, no doubt, it's been a persistent headline globally for the better part of 3 years, right? From supply chain shocks post-COVID to energy disruptions following Russia's invasion of Ukraine, the ripple effects are still being felt across economies. Now, not all countries are experiencing it in the same way, though. According to the International Monetary Fund, inflation is projected to remain above 2%, which is typically the traditional target in much of the world through the end of 2025. Now, the U.S. finds itself in a relatively moderate position compared to many of its peers. While parts of Western Europe are finally beginning to normalize, other regions are still contending with elevated price pressures. I'll give you an example. The Sub-Saharan Africa projected 13.3% inflation. Emerging Europe, 13.5%. The Middle East and Central Asia, 11.1%. Latin America and parts of Asia remain in the 8 to 20% range for inflation. Good Lord. And countries like Venezuela, I almost hate to say this, 180%. Zimbabwe, 92%. And the Sudan, 100%. They're facing hyperinflation. So for the U.S., headline inflation, it's finally cooled substantially from 2022's peak, aligning more closely with developed market averages. But pressures still remain, right? Particularly in housing and energy and labor, keeping inflation slightly above the Fed's 2% target, which we've talked about at length in previous Let's Talk Markets. So once again, inflation, why does it matter for investors? Inflation affects everything, from purchasing power to interest rates and asset valuations. Understanding how the U.S. stacks up globally can offer perspective, especially as central banks diverge in policy responses. While the worst may finally be behind us, inflation remains a global story, and localized differences will help shape investment opportunities moving forward. Okay, on to our final point, and I am really excited about this. This is called Finance Facts You Didn't Know You Needed. All right, so we talked about data, we talked about policy and headlines, but let's end on something a little bit different. The market has its own oddities and quirks that don't always make the news, but still make you kind of stop and think. So I found 5 facts from the world of finance that I thought you might find interesting, and I bet you didn't know. All right, let's start with the first one. Did you know the New York Stock Exchange has a zip code of its own? That's right. Zip code 10005 is associated exclusively with the New York Stock Exchange. And that New York Stock Exchange is on Broad Street. Most buildings actually share zip codes, but the volume of mail and the identity code of the New York Stock Exchange, it justified its own zip code. All right, number 2. The original stock ticker didn't actually tick. Invented in 1867, the first ticker tape machine used telegraph signals to report prices, right? These machines printed abbreviated company names and price data on narrow strips of paper that made a ticking sound as they printed, hence the name, ticker tape. That sound and the printed codes being synonymous with the way we track stocks today, giving rise to the term ticker. A little bonus fact on this one, the first ever stock ticker symbol, it was RR. Anybody want to take a guess what that's for? For the railroad industry. And that was back in the 1860s. All right, number 3. Do you know that Warren Buffett still lives in the house that he bought in 1958? He bought it for $31,500. So despite being worth over $166 billion today, Buffett has remained loyal to his modest Omaha home. Now, today it's worth over $1 million, but to him, it's one of his best long-term investments. Unreal. Number 4, the U.S. once issued a $100,000 bill featuring Woodrow Wilson. Back in the 1930s, actually, the Treasury produced $100,000 bills that were only used between Federal Reserve banks. So they weren't in general circulation. So unless you're a bank, you probably have never seen one of these things. Can you imagine holding a $100,000 bill? I'd be so scared. Blowing away or something like that. Good gosh. Number 5, the last one, the stock market is closed more days than you think. In a typical year, the U.S. stock market is only open about 252 trading days, meaning it's closed over 100 days, including weekends and holidays. That's nearly 30% of the year with no trading at all. That was surprising to me because it feels like I'm working more than 70% of the time. So, will any of these facts improve your portfolio or help you retire early? Probably not. But hey, knowledge compounds just like interest. Okay, as we've recently seen, market volatility can create significant uncertainty, right? And the people you care about may be feeling unsettled about their financial future. So, if you have a friend, a family member, or a colleague who could benefit from a trusted second set of eyes on their investments, now is the perfect time to introduce them to our Second Opinion service. We created this service so that anyone can come to us with their current investments or their financial plan or strategy and just gain a fresh perspective, ensuring their investments align with their unique goals and provide the reassurance that they're on the right track. So, if someone you know could benefit from this clarity, we encourage you to reach out to us anytime. We'd be honored to help. Well, as I said before, we're so grateful that you've joined us today, and we encourage you to share this content with anyone who might find it valuable. And so we have the replays of our Let's Talk Markets posted on our YouTube page. And YouTube, it's also home to episodes of our podcast, Between the Bears and the Bulls. And so I don't know if everybody has seen it, but we've been releasing new episodes every month, and the reception has been really positive. So thank you so much for the feedback. But if you do have any suggestions on what you'd like to see from us, just let us know, right? We want to make sure that the content that we're putting out and we're investing in for y'all is valuable to you. Oh, and that comes to mind, one more thing before I go. What do you call a fish wearing a bow tie? Sophisticated. All right, we'll see you next month for September's edition of Let's Talk Markets. And don't forget, leave it to Beavers.